Welcome to video 5 of part 2 of the EA Tax Training Enrolled Agent Exam Preparation course. Tom here back with you to discuss sole proprietorships and partnerships. Up until now, we've been talking about things that affect all businesses, such as income, expenses, asset basis, etc. But in these next few videos, we're going to get into the specifics of each different type of taxable entity, obviously starting with this one, sole proprietorships and partnerships. Free resources here. We've got 2 for each of the types of entities. So for sole proprietorships, Schedule C for Form 1040, profit or loss from business, along with its instructions, in IRS Publication 334, Tax Guide for Small Business. We've recommended that one a couple of times already. And then for partnerships, Form 1065, which is the partnership tax return, along with its instructions, and Publication 541, which covers partnerships. Starting with sole proprietorships, what we will look at specifically is we will have a look at Schedule C. Then we will talk about owner's pay. How does a sole proprietor pay themselves? Then we'll look at the self-employment tax, health insurance for sole proprietors, and retirement for sole proprietors. So an overview. Remember that a sole proprietorship not only includes just a regular unincorporated business where one person goes into business, doesn't set up any type of entity. It also includes a single member LLC, which is considered a disregarded entity, unless the LLC elects to be taxed as, for instance, an S corporation. But if you just have a single member LLC, don't do anything else, then you are automatically a sole proprietor. Sole proprietors file on Schedule C of Form 1040, so there's no separate tax return like there is for all of the other entities. And sole proprietorship includes a qualified joint venture, which is actually a type of partnership. We talked about this in video 1, but just to recap, this is between a married couple that each materially participate in the business, and they agree to file as a qualified joint venture. So in that case, instead of having to go the partnership route and file a separate Form 1065, they can simply file 2 Schedule Cs, one for each spouse. So they get their share. So if they're 50-50, then they each get half the income, half the expenses, and they would file that on their separate Schedule Cs. And then they would also have separate Schedule SEs to report their self-employment income. If an individual or a couple has more than one business, then they should each file their own Schedule C. So if you've got more than one sole proprietorship, say you've got 2 different sole proprietorships that you run, then each should have its own Schedule C. Whether or not to include them together is a bit subjective. So you just kind of look at, are they in similar lines of business? If they're similar, then maybe you include them both on the one. But if you've got 2 really completely different types of businesses that you do, then you should have them on separate Schedule Cs. And then for all sole proprietorships, the income just flows to Form 1040 because Schedule C is part of Form 1040. So it just flows right up to the front page of the 1040. And the income, of course, is taxed at individual tax rates. This is a look at the Schedule C, so we'll just do a bit of an overview. Of course, you're going to want to get this and go over it and make sure you're familiar with it. So it starts with your name at the top, and then the type of business. We talked about this in video 1, where you put that code in depending on your industry. Your business name, if it's separate. If you don't really have a business name, you're just yourself going out and doing business, and you don't have to put anything there. Your address, which if that's just your home address, that's fine. You can put that in there. You do have to choose your accounting method. Most sole proprietors are on the cash method, but you would put your accounting method there. Whether or not you materially participate, you check the box. If you just started the business during the year, then you check the box. Did you make any payments that would require you to file a Form 1099? So remember, we talked about how you have to file 1099s if you, for instance, hire an individual to do work for you, but they're not an employee, and you pay them more than $600 a year. So if you're required to file any Form 1099s, you would check the box yes. If not, then obviously no. And then if you do check yes to that box, you have to say whether or not you filed those 1099s. So you want to make sure it's kind of a reminder that if you haven't filed the 1099s, you need to do so. But they just want you to acknowledge whether or not you did file those. Then we go on to the more familiar things that we've seen. Put in your income, cost of goods sold, your gross profit, other income gives you your gross income. And then this is a list of the different types of expenses you might have. Your expenses might be different from these, so you would fill in these as appropriate. And then anything else you could just put on this other expenses line. And we'll see on the next page that there's a place where you can list out what are those other expenses. And then it comes down to your total expenses, and it has a spot here for business use of your home that you would put on here. Comes down to your net profit or loss and remind you about Schedule SE, etc. Moving to the next page, there is a whole section for cost of goods sold. So you'd have to say which method are you using. Remember when we talked about LIFO, FIFO, average cost, those are all the cost methods. So most of the time you're using the cost method. And then it talks about, was there a change in determining quantities or costs? In other words, did you change your method during the year? And if yes, you have to attach an explanation. Remember, if you do change your method, you are supposed to file the form for changing an accounting method. Then it asks for your inventory at the beginning of the year. So remember, cost of goods sold, inventory plus purchases minus ending inventory gives you your cost of goods sold. So this is just asking for the details of that. Then you move on down here to part 4, and this is if you use a vehicle. So if you're claiming any car or truck expenses, then you need to fill all this out. When you placed it in service, total number of miles driven during the year, total for business, total for commuting if you had any, and then other miles. So that would be like other personal miles that you drove it. Then it asked you these questions. Was your vehicle available for personal use during off-duty hours? Yes or no? Do you have another vehicle that you could use personally? Do you have evidence to support your deduction? So were you keeping some sort of log or an app on your phone or something to keep track of your miles? And then if so, is that evidence written? And obviously, if it's on an app, it would be considered to be written. And then part 5 here is that's the other expenses that you showed on the first page. This would detail those. What were they? And then you would put the amount over here to the right, and those should total up to what you've got for other expenses back on page 1. Owners pay in a sole proprietorship. If you are a sole proprietor, then you don't use payroll for your own pay. You might have other employees and you may have payroll for them. If you do have other employees, you should have payroll for them. But you don't put yourself on payroll. Instead, you take pay by making withdrawals. So you've got money in the bank account and you want to pay yourself, you just simply take the money out of that business account, put it into your personal account, or take it as cash, whatever you want to do. Taxable income is not dependent on the amount of your draws, on the amount that you take out. You're going to pay tax on the profit of the business, regardless of how much cash you take out, because the amount that you withdraw might be more or less than the amount of profit from the business, and you're going to pay tax on the profit of the business regardless. Self-employment tax, we've been over this a couple of times, but just a little bit of a reminder. This goes on Schedule SE. The first $160,200 of your income is subject to the Social Security portion of the self-employment tax. There's no cap on the amount that is subject to the Medicare portion of the self-employment tax. And then half of the self-employment tax is deductible as an adjustment to income on Schedule 1 of the Form 1040. So it doesn't go on Schedule C, it goes on Schedule 1 of the 1040. And of course, that half that you're getting to deduct represents what would be the employer's share of the Social Security and Medicare. Health insurance for a sole proprietor. Premiums that are paid for the owner's health insurance and other fringe benefits are not deductible on Schedule C. So you don't put them on Schedule C, but Self-employed health insurance premiums are deductible as an adjustment to income on Schedule 1 of 1040 as long as you qualify, and we'll talk about that on the next slide. Limited amounts of long-term care insurance can also be included in the self-employed health insurance deduction. So let's just do a reminder on that self-employed health insurance deduction. We did talk about this in part 1. So you have to be self-employed and not eligible for subsidized health insurance from your or your spouse's employer. So if you've got a regular job that has health insurance and you've got a sole proprietorship on the side, then you cannot take this self-employed health insurance deduction. Or if you are self-employed and this is all you do is your business, your sole proprietorship, but your spouse is eligible for subsidized health insurance, even if you don't take advantage of it, if you're eligible for it, then you cannot take the self-employed health insurance deduction. Then you have to have a profit from the business to cover the deduction. So if you don't have at least as much as the premiums for the health insurance, then you're not going to be able to deduct all of them. You can still deduct the amount of profit that you have, but you can't deduct more in health insurance than you have profit from the business. If your spouse is also an employee of your business, then what you can do is buy a policy in their name, and then you as the owner can get coverage as the spouse of the person who's covered by the insurance. So it's another way to get health insurance for you as the sole proprietor, as well as for your spouse and your family. Retirement. In a later video, one of the specialized topics videos, we're going to go more in depth about retirement for businesses. But I just did want to point out here in a few slides what your options are as a self-employed person for retirement. You can set up a SEP or a simple plan or other qualified plan. They are not deductible, though, on Schedule C. Instead, they are deductible as an adjustment on Schedule 1 of the 1040, similar to the health insurance. A SEP is a self-employed pension. You can contribute up to 25% of your net earnings from self-employment up to a maximum of $66,000 for 2023. So that maximum $66,000, that's the amount that you can contribute. So 25% of your net earnings up to a maximum contribution of $66,000. You can establish the plan. It's a simple one-page form that you can do at a bank or financial institution. So it really is a simple way to set up retirement. And $66,000 a year, or 25% of your earnings from self-employment, is a good amount to be able to put away for retirement. So it is a good option for a sole proprietor. There's also a simple IRA or a simple plan. You can contribute all of your net earnings from self-employment up to a maximum of $15,500 plus an additional $3,500 if you are age 50 or older. And you can set up that plan through a financial institution between January 1st and October 1st of the year that you want it to be effective. So if it's 2023, you want to set that plan up between January 1st and October 1st of 2023. However, if you don't start your business until after October 1st, then you just need to set it up as soon as it is feasible for you to do so. 401k plan. First of all, you can contribute to an employer plan as normal. So again, you've got a job and then you've got a sole proprietorship on the side. You can still go ahead and contribute to your employer's plan up to the normal maximum of $22,500 with an additional $7,500 if you're age 50 or older. In addition, you can contribute up to 25% of your net earnings from self-employment up to $66,000 to your own 401k plan at your business. So if your business has a 401k plan, this is the amount that you can put in as a self-employed person. And you can do a solo 401k. So if you don't have any other employees, so you don't have a regular 401k plan set up with your business, you can do a solo 401k plan. There are other types of plans: profit sharing, money purchase plan, defined benefit plan. Those are not common for sole proprietors, but they are available, and we will talk more in depth about those in video number 9 when we talk about specialized topics. Now let's move on to partnerships, and let's talk a little bit about partnerships. Good news, bad news on partnerships. Bad news first. Partnerships can be very complex. There are CPAs and attorneys who spend nearly all of their professional time dealing only with partnerships, because you get some of these large partnerships with very complex partnership structures and lots of different partners, and partners coming in, partners leaving, partners contributing into the partnership, partners taking distributions of not only cash but different types of property from the partnership. You can get into lots of very technical, very difficult issues, so technical and so difficult that these professionals spend all of their time dealing only with those issues. That's the bad news. The good news is, for the EA exam, you're not going to have to deal with all of those really complex issues. They're only going to test you on the very basic concepts of partnerships. So that's what we are going to deal with in this video, is what you need to know for the EA exam. Just know, as we're going through this, some of the concepts are going to be, they're going to seem pretty simple, and they are pretty simple in the simplest cases. But once it starts to get complex, these seemingly simple concepts can get to be really difficult to deal with. So just know that when you are thinking about handling partnerships as part of your practice, when you actually get out and start doing returns, if you're just dealing with a simple partnership, two friends opened a little business, and there's nothing really complicated, that's fine. But if you get into a partnership that's got a very complex structure, then you might think about whether or not it's a client you really want to take on. So that's the good news, bad news about partnerships. For the EA exam itself, you should be fine. Just go through this video and through the publication and the instructions that we talked about earlier to get a feel for what the rules are, and you'll be fine for answering the questions you need to answer. So specifically, what are we going to look at with partnerships? We will look at the Form 1065 and talk about them in general. We will talk about how partners get paid, and then profits, losses, and separately stated items. We'll talk about making contributions to and taking distributions from the partnership. We'll talk about basis, disposition of a partnership interest. So a partnership interest can be sold or otherwise disposed of. So we'll talk about that. Then we'll look more at Schedules K and Schedules L. So you've got Schedule K along with K1, and then you've got Schedule K2 along with K3, and then Schedule L, which is the balance sheet, along with M1, M2, and M3. We will look at and talk about all of those. And then we will handle a couple of miscellaneous partnership topics at the end. So partnerships in general, remember, a partnership in its simplest incarnation is just two or more people who get together and they start a business. They don't go to the state and form any type of entity, and they're two just individual people and they start a little business, and now it is a partnership. So it's like a sole proprietorship, except that there's more than one person. So it can be two people, they are starting a business, they are a partnership. The partnership itself generally does not pay tax. Instead, the profits or losses pass through to the partners and are taxed on their separate tax returns. So this is why the partnership needs their own tax return, because they are going to report the total profit or loss of the partnership, and then they have to report out on this Schedule K1 to each partner their share of those profits and losses. As we are going through this, for simplicity's sake, I will often speak of the partners as if they were individual taxpayers. It's just easier to discuss that way, and it's more relevant to what you're likely to be tested on the EA exam. Most of the questions there are going to assume individual taxpayers as being the partners. However, not just individual partners can be partners in partnerships. You can also have corporations. C corps and S corps can be partners in partnerships. Other partnerships can be a partner in a different partnership. Estates can be a partner in a partnership. Trusts can be a partner in a partnership. So all of those things can happen. So remember before, when I said how you've got these tax professionals who spend all of their time dealing only with partnerships, you can imagine how complicated it can get when you've got S corporations, trusts that are partners in a partnership. You get some of these family partnerships that are set up for estate planning purposes, and they'll have different trusts and S corps and individual people who are all partners in the partnership. And you've got people entering and leaving. You've got people selling their partnership shares to other family members, and then somebody dies. So now their estate becomes a partner in the partnership. And so all of these things are what can make it so complicated. So as we go through these videos, let's focus on individual human beings being the partners in the partnership. That makes it easier to think about and easier to understand, but just know that all of these other different types of entities can also be partners in the partnership. The same general principles that we will talk about will apply to those other entities. It's just that it's a little bit more complicated when you are dealing with that. So here is page 1 of the Form 1065, the partnership tax return. So at the top, you do need to put in your taxable year if it is not a calendar year. So the assumption is it's a calendar year. However, it may not be, because you'll remember the partnership is supposed to use for their tax year the same tax year as their majority of partners. So if we're dealing with individuals, as we're assuming here, then that would be a calendar year. But if a corporation, for instance, with a different tax year end is a majority partner, then you would be required to use that corporation's tax year unless you met one of those exceptions and got permission to do differently, as we discussed in a previous video. Then we move on to the name, address, the principal business activity, which is that code we talked about, principal product or service. They want you to actually put in words what is your main product or service that you deal with, when the business started, total assets. So you'll put that comes from the balance sheet. You put that up here. Then you'll see there's some boxes to check. If it's your first return, if it's your last return of the partnership, if there's been a name change, address change, if it's an amended return. Then you check your accounting method. We've talked about that before. What method are you using? The number of K1s that you are attaching, and check if Schedule C and M3 are attached. We will talk about that. This is Schedule C for Form 1065. This is not Schedule C from Form 1040, which is what we talked about on sole proprietorships. So we will talk about those towards the end of this video. And then you've got a couple of other check boxes here that could apply for at-risk or passive activity purposes. Then we move down to the income, as we have seen before, income, cost of goods sold, etc. Then we have expenses, and of course the other deductions. And for here, if you have other deductions, then you attach a statement explaining and listing out what those other deductions are. And then this brings you down to the balance, where you've got a couple of other things that you can have. We'll talk about this BBA and other taxes that you could have. So a partnership in general does not pay taxes, but there are a couple of exceptions to that. So If you have one of those exceptions, then the amount of tax that you owe would be down here. And then you get to the bottom with the signatures. There are more pages to the 1065, and we will look at many of those as we go through this video. The filing deadline, as a reminder, for partnerships is the 15th day of the third month following the end of the tax year. So that is March 15th for a calendar year partnership. Can, of course, request a 6-month extension. So that would take you out to September 15th for a calendar year partnership. The penalty for late filing is $235 per month multiplied by the number of partners. So it's $235 per month for a maximum of 12 months, but that's for each partner. So if you got a lot of partners, it can get expensive. On some of the other returns, the returns like your 1040, the penalty for late filing is based on the amount of tax you owe. But since a partnership usually does not owe any tax itself, they put in this flat amount per month per partner instead of having it be a percentage. So you'll want to remember that for the exam, the $235 per month up to a maximum of 12 months, and that is per partner. So partner pay and pass-through items. For partner pay, if you have a partner who is active in the business, they are compensated with cash payments similar to how an employee would be paid. However, they are not considered employees and they are not included in payroll. So they're not subject, therefore, to your typical payroll taxes, your Social Security and Medicare, unemployment, etc. Instead, these payments are called guaranteed payments. So a partner, instead of getting a salary, so if they work in the business, instead of getting a salary, they receive guaranteed payments. They're called guaranteed payments because the partner gets the money whether the partnership is profitable or not. They're getting the money because they work. They're working in the partnership. They're not getting the money because the partnership is profitable. So if you think of a partnership and you're going to make a profit and then the partners share in the profits, that's kind of the point. But the guaranteed payments is not their share of the profits. It's separate from that. And so it's going to be treated differently on their tax return than a simple share of the profits is treated. Guaranteed payments are treated as if they were paid to a third party. Therefore, they are deductible by the partnership. So much like a salary that the partnership would pay, the partnership can deduct the guaranteed payments that they make to the partners. And of course, the guaranteed payments are taxable directly to the partner. There can also be guaranteed payments for use of capital. So we're going to talk in this video, but mostly about the ones for services. You work for the partnership, you get paid by the partnership, that's a guaranteed payment. But you can have guaranteed payments that would be similar to interest. So you put money in to the partnership and the partnership pays you an amount every so often for use of that capital. That would also be considered a guaranteed payment. It would also be deductible by the partnership. It would be taxable to the partner who received it. But it is a little bit different because it's not self-employment income, so it wouldn't be subject to self-employment tax, for example. So just know that you can have guaranteed payments for both services and capital, but for the rest of the time, when we're talking about guaranteed payments, we're going to be referring to those that are in exchange for services rendered. Guaranteed payments, as we said, are considered self-employment income. They are reported to the partner on Schedule K-1. So an employee would get a W-2. The partner's not going to get a W-2. Instead, on their K-1 will be a line that reports their particular guaranteed payments that they received. The partner has to file Schedule SE on their Form 1040 and pay the self-employment tax. They can also deduct self-employed health insurance, just like a sole proprietor can, assuming they meet the requirements for that. And then fringe benefits that they get are generally also going to be considered to be guaranteed payments. So it's a little bit different than if you are an employee and some of those fringe benefits are not taxable. They will generally be taxable and be considered guaranteed payments. Partners' share of the profits. So there should be a partnership agreement in writing. That is the recommendation. If not, there will be some sort of general understanding between the partners. So maybe you've got two people who are partners and they agree that they're 50-50 partners. But in either case, it should spell out the percentage of profits that are going to be allocated to each partner. Again, best to have this in writing so there's no misunderstandings later. Like later on, somebody says, well, I put a lot more effort into this. So I know we said we were going to be 50-50, but I should really get 80% and you should get 20%. You can avoid those types of arguments if you have a written partnership agreement that spells it out in black and white. Here's what the profit percentages are. The profit percentages can be different than the capital percentages. So, for example, Abe and Ben form a partnership. Abe contributes $1,000 and Ben contributes $99,000. Since Abe has the expertise needed to run the business, the partnership grants 25% of the profits to Abe and 75% of the profits to Ben. So what you could have here is where their capital percentages are 1%, 99%, but in this example, their profit and loss percentages are 25%, 75%. And it can be whatever percentages you want them to be. But the point here is that they can be different. And why that is significant is because it's different with an S corporation. So sometimes businesses, when they're first starting up, are trying to decide, should we be a partnership or should we be an S corporation? This is one of those things that can make you lean toward being a partnership rather than an S corporation, is you've got this flexibility to have these different capital and profit sharing percentages. You don't have that with an S corporation. Profits from the partnership flow through to the partner's separate tax return, as we've said several times, and they do this via Schedule K1 from the 1065, and we will look at that in detail later. And remember, those profits are taxable whether or not cash is distributed to the partners, as we discussed previously. Separately stated items. Some items of income and expense are not going to be recognized by the partnership itself. So on that first page of the partnership return, where we showed the income and we showed the expenses, there are going to be some things that don't show up on that page one. Instead, they are going to be passed through directly to the partner as a separately stated item on the K1, so then the partner will recognize that on their own 1040. And it says possibly recognize it because it's going to depend on the particular item and the particular partner's tax situation. Some examples of separately stated items: interest, dividends, capital gains and losses, those portfolio income or investment income types of things, not listed on page one and included in the partnership's income. Instead, they are separately stated to each of the partners. Section 179 deductions, that we talked about that in the assets and depreciation video. Charitable contributions, and the QBI information. Back in part one, we talked about that QBI deduction. So the information in order for the partners to take that QBI deduction will be separately stated on the K1. And again, those are just examples. There are many other things that will also be separately stated on the K1. So let's look at an example. STL Partnership, which is owned equally by Stan and Lee, has revenue of $200,000 and operating expenses of $125,000. So on page one of their tax return, they are going to show $200,000 of revenue, $125,000 of expenses. So they're going to show $75,000 of profit. However, they also have $20,000 of Section 179 expense and $2,000 of charitable contributions, which are not included in the operating expenses. Their operating income, as we said, that's shown on page 1, is going to be the $75,000. But in addition, they are each going to be allocated $10,000 of Section 179 expense and $1,000 of charitable contributions for possible deductions on their Form 1040s. So their K1 is going to have, each of their K1s is going to say $37,500 of business income from the partnership, because they get half of the $75,000. And then each of their individual K1s is going to show 179 of $10,000 and charitable contributions of $1,000. They will then take that information to prepare their Form 1040. And again, it's just a simple example. They could have a lot more separately stated items of that, but just trying to give you an idea of how that works. Related party transactions. A partnership cannot deduct a loss on the sale of property to a related party. A related party includes a partner with direct or indirect ownership of more than 50% of capital or profits, and any of their family members. So that's siblings, half siblings, their spouse, their parents or grandparents, their children, grandchildren, etc. All of those are considered related parties. Now, when it says a partner with direct or indirect ownership of more than 50% of capital or profits, what does indirect ownership means? Well, you could have, for example, again, let's get back to some of these family type of partnerships. You can have trusts that are part of it. So a person as an individual might own, let's say, 20% of the partnership, but then they've got a trust, and that trust owns another 40% of the partnership. So indirectly, that individual owns 60% of the partnership. So that's what it means when it says directly or indirectly. So you either, as an individual person, own more than 50%, or when you combine your individual ownership with your ownership through these other entities, you've got more than 50%. So that's what that means, direct or indirect. And then family members is just these that are listed. So for the exam, just remember direct or indirect ownership of more than 50% and a general idea of what the family members are for those. And again, this is for a loss on the sale of property to a related party. If you had a gain on the sale, you would report that. This is only losses that cannot be taken if the partnership is selling property to a related party. Contributions and distributions. So this is making contributions to a partnership or taking distributions from a partnership. Contributions to a partnership. Partnerships are typically formed by the partners making contributions. So they contribute either cash or some sort of property to become partners in the partnership. The partners get basis in the partnership based on the amount of their contribution. And we're going to talk more about basis coming up. But the reason that's important is because a partnership interest can be bought or sold, just like other property can be bought or sold. And so you need to know your basis in the partnership in order to compute your gain or loss when you sell or dispose of your partnership interest. For cash contributions, their basis in the partnership is equal to the amount of cash, of course. That's the easy part. For property that's contributed, their basis in the partnership is equal to their adjusted basis in the property itself minus any debts that are assumed by the partnership. So, for example, sometimes a person will contribute a building to the partnership, that's their contribution. Instead of, or in addition to, putting in cash, they will contribute a building. And maybe that building has a mortgage on it that the partnership is now going to assume that mortgage. So their basis that they get for contributing that building is their adjusted basis in the building itself minus the amount of mortgage that is being assumed by the partnership. So if they put in a building that has an adjusted basis of $200,000, but they've got a $100,000 mortgage on that, then their basis in the partnership is going to be $100,000 for that contribution. And generally, neither the partner nor the partnership is going to recognize gain upon a contribution of property to the partnership. And the partnership inherits the adjusted basis and holding period of the partner. So if the partner has owned that building for more than a year, then it is a long-term asset for them. And so the partnership would simply step into the shoes of the partner. So the partnership now is assumed to have the same adjusted basis as the partner, and they are assumed to have owned it for more than 1 year. So that's what that is referring to. Disguised sale. So sometimes taxpayers and their tax advisors want to play games. And so this is one of those things that the IRS has to put a rule in to prevent people from playing games. So sometimes a partner's contribution of property and subsequent receipt of a distribution from the partnership can be considered a disguised sale. So this would be the partner puts in a building, and then a few months later, magically, they get a $200,000 distribution of cash from the partnership. So that could be considered a disguised sale. So you didn't actually contribute the building to the partnership. You are actually selling the building to the partnership. You were just trying to make it look like a contribution. That's what they're saying. It's a disguised sale. So if that happens, the partner has to recognize the gain just as if they had sold it. And then the partnership recognizes the purchase of an asset. So the partnership would still get basis in the asset for the amount that they purchased it for. In other words, for the amount of the distribution that they gave to that partner. And the gain is computed as the fair market value of the property on the date of the contribution minus the partner's basis at the time of the contribution. For the disguised sale, the partner contributes property and the partnership makes a distribution of different property, oftentimes it's cash, but it doesn't have to be, to the partner, and both of the following are true. That distribution would not have been made but for the contribution of the property, and the partner's right to the distribution did not depend on the success of the partnership operation. So that's what they're saying. This is when it is going to be considered a disguised sale. You contribute the property, you get some other property back out, which might be cash, and you would not have gotten that distribution if it weren't for the fact that you had made the contribution of the property, and the distribution that you got was not dependent on whether or not the partnership itself made a profit. You were getting that distribution regardless. That would be considered a disguised sale. If the contribution and distribution occur within 2 years of each other, it will be presumed to be a disguised sale if you meet this criteria, unless the facts and circumstances clearly demonstrated that it was not. In other words, if you have this contribution and subsequent distribution, and those happen within 2 years, and that distribution would not have occurred except that the contribution was made, and the right to the distribution did not depend on the profitability of the partnership, then it will automatically be considered a disguised sale unless you can prove that it clearly was not. Contribution of services. So a partner can acquire either a capital interest or a profit interest as compensation for services performed or to be performed. For a capital interest, this would give the partner a share in the proceeds if the partnership assets were sold and the proceeds were distributed to the partners. So when we talk about a capital interest, and later in this video, we will talk about your capital account. But what a capital interest means is kind of like your stock interest in a corporation. That's your capital interest. So if we sold all of the assets, paid off all the debts, what's left over, of course, would go to the owners, and that is the partners And so that is your capital interest. So you get some percentage of the ownership interest in the partnership. A profits interest is any interest other than a capital interest. So what that usually means, it's an interest in the share of any profits. So if you've got a 10% profits interest and the partnership has a $100,000 profit, then your share is 10%. That's what the profits interest is. And you can get one of those interests. You don't have to contribute cash or other property to get that interest. You could get that as compensation for services. So you're an important part of the business and the work you do is valuable. And so, as part of the compensation for that, the partnership agrees to give you either a capital interest or a profits interest or both for in return for your services. If an individual receives a capital interest in exchange for their services, the fair market value of that interest is a guaranteed payment and is therefore taxable income to the partner. If an individual receives a profits interest in exchange for their services, it is not generally going to be considered a guaranteed payment, and therefore it is not taxable. There are some exceptions there, but for purposes of the EA exam, I want you to focus more on the big picture. Don't get lost in the details. And the big picture is if the partner gets a capital interest, it's a guaranteed payment at the fair market value of that interest. If they get a profits interest, it is not going to be considered a guaranteed payment. So that's the distinction that you want to know for the EA exam. And you can, at your own leisure, you can read those exceptions. Distributions from a partnership. So distributions can be made for a variety of reasons. Some of those reasons are listed here. Could be a distribution of earnings, could be a distribution to pay taxes on earnings, could be a distribution in anticipation of earnings coming up, could be a complete or partial liquidation of the partner's interest in the partnership, or it could be a liquidation of the partnership itself. So the partnership's simply going to go out of business and they're going to distribute the proceeds out to the partners. Distributions that are made reduce basis and capital accounts. So we'll go more into detail about that later. But for now, just remember that distributions reduce basis and they reduce capital accounts. Distributions of earnings are not taxable per se. Tax is paid on the profits regardless of the distributions, as we have mentioned a few times before. Now let's talk about basis. And when we talk about partnerships, we talk about two different types of basis, inside basis and outside basis. And it is important that you understand the difference. And it's not complicated, but you do need to know the difference between inside basis and outside basis. So the inside basis is the partnership's basis in its assets. So the partnership has a building, maybe. It has different machinery and equipment. It's got various assets, just like any other business would have assets. And of course, it has a basis in those assets, just like any other business would have a basis in those assets. That's inside basis. Outside basis is the partner's basis in the partnership itself. So as we said before, this is what's important. If the partner decides to sell or otherwise disposes of their partnership interest, we have to be able to compute the gain or loss of the disposition of that interest. And so in order to compute that gain or loss, we need to know what is their basis in the partnership. So again, if we compare it to a corporation, as if an individual owns stock, their basis in the stock, of course, is going to be how much they paid for that stock. Well, for a partnership, it might include more than just how much they paid. As we'll talk about later, there are different things that affect basis, but it's the same basic idea. That is, what is their cost or their basis in their ownership of the partnership itself. So that is their outside basis. So inside basis, that's normal basis of the partnership's assets that the business has in its own assets. Outside basis is the partner's basis in their share of the partnership itself. So inside basis. So we're going to do an example to understand the difference here. Partner A contributes a building with a fair market value of $200,000 to form a partnership with partner B. Partner's A basis in the building at the time of the contribution is $100,000. The partnership now has a building on its balance sheet with a basis of $100,000. That is the inside basis of the building. So remember, when a partner contributes property to a partnership, it is not the fair market value that counts. It is the partner's adjusted basis in that property. So in this case, partner A's basis was $100,000. So therefore, the partnership takes on that basis. That basis, the partner's basis, becomes the partnership's basis. So now the partnership has a basis in that building of $100,000. Now, partner B contributes $100,000 of cash for her share of the partnership. The partnership uses $50,000 of that to buy equipment, and then the other $50,000 is just sitting in the bank. So the partnership's inside basis in its assets is now $200,000. It's got $100,000 building that it got from partner A. Then it has $50,000 of cash that it got from partner B, and it's got $50,000 of equipment that it purchased with the cash from partner B. That's the inside basis of the partnership. Outside basis is each partner's basis in the partnership. So in the previous example, each partner starts with a $100,000 basis in the partnership. Partner A put in a building with an adjusted basis of $100,000, so that's their basis. And partner B put in cash of $100,000, so that's her basis. And so the total outside basis combined is $200,000. And at the moment, that is the same as the inside basis. However, over time, the inside basis of assets is going to change. The outside basis of the partners is going to change, and they're going to change differently. And so over time, those can be two very different numbers. And so that's why we need to distinguish between those two types of basis. When does inside basis change? Well, it's just like any other business. You have assets, the basis for those assets can change. So, for example, if you make improvements to the asset, then the asset basis will go up. If you take depreciation on the asset, then the basis will go down. You could have theft or damage that's not covered by insurance, but it's still deductible. So that would decrease the basis. You could get insurance proceeds because of damage to the property. That would increase the basis. So you got all the normal increases and decreases that you would ever have with different types of assets that would increase or decrease the inside basis for the partnership. What changes the outside basis? Outside basis is increased by the following: additional contributions that are made by the partner, including an increased share of or assumption of partnership liabilities. So this includes a partner personally guaranteeing a partnership loan as long as certain criteria are met. So this is one place, again, that's different between a partnership and an S corporation. If a partner in a partnership personally guarantees a partnership loan, then they generally will get basis in the partnership for that guarantee. Whereas that is not true with an S corporation shareholder. If an S corporation shareholder personally guarantees a corporation loan, they do not get basis. So we want to remember that partner does get basis for guaranteeing a partnership loan. Their basis is also increased for their share of taxable and non-taxable income. So basis goes up with the taxable income of the partnership. It also goes up for non-taxable income of the partnership. And basis is increased for the partner's share of excess depletion over the basis of depletable property, unless the property is oil or gas wells whose basis has been allocated to the partners. We're not going to go into the details of that. Just remember it's on the list. Excess depletion is on the list. So just remember excess depletion increases outside basis. So, what decreases outside basis? The following items do, although never below zero. So, your outside basis can never be below zero, but outside basis is decreased by the following: money and adjusted basis of property distributed to the partner, including a decreased share of partnership liabilities or an assumption of the partner's individual liabilities by the partnership. So again, if you contribute property and it's subject to a loan, well, the partner is no longer on the hook for that loan. So their basis is going to be decreased by the amount of the loan that was taken over by the partnership. Outside basis is also decreased by the partner's share of partnership losses. So just like partnership profits increase basis, partnership losses decrease basis. Also decreased by the partner's share of non-deductible partnership expenses. So just like non-taxable income increases basis, non-deductible expenses decrease basis. And this includes Section 179 expenses, even if the partner cannot deduct all or part of them. And it's decreased by the partner's deduction for depletion for oil and gas wells up to the proportionate share of the adjusted basis of the wells allocated to the partner. So again, just remember for the exam, depletion for oil and gas wells also decreases outside basis for the partner. Outside basis is also decreased by the partner's share of foreign taxes paid or accrued by the partnership, and by the partner's share of the adjusted basis of the partnership's property donation to charity. So if the partnership makes a donation of property to charity, then the adjusted basis of that will decrease that partner's outside basis in the partnership. So let's do an example. C and D form a 50-50 partnership in 2022 by contributing $25,000 cash each. The partnership loses $10,000 for the year. So at the end of 2022, C and D each have a basis of $20,000. So they're $25,000 that they put in, and then each of them gets $5,000 of the $10,000 loss. So each individual partner has a $20,000 basis in the partnership. In 2023, the partnership has a profit of $20,000. In addition, there are 179 deductions of $12,000. So at the end of 2023, C and D each have a basis of $24,000. So it's the $20,000 that they had at the end of 2022, plus each one gets $10,000 of the $20,000 profit, and each one is going to subtract $6,000 of the $12,000 Section 179 deduction, leaving them with their $24,000 basis. So for the exam, you should know how to do a simple example like this. They're not going to get too convoluted on you, too complicated, but you should be able to do a simple calculation like this one. So come back, understand the rules, and just understand how these increases and decreases can happen. Partnership liabilities. As we said, a partner's basis in the partnership, their outside basis, includes the partner's share of partnership liabilities, but only if and to the extent that the liability creates or increases the partnership's basis in any assets, including cash. So in other words, if the partnership gets a loan of cash from the bank, that's going to count, obviously, because now they've got cash sitting in their bank account that they didn't have. So they've got an asset that they didn't have, but it doesn't have to be cash. But the point here is that you just had to have gotten something. The partnership had to have gotten something in exchange for the liability in order for the liability to count. So that's the more straightforward. But the other options are it gives rise to a current deduction to the partnership, such as trade accounts payable for an accrual basis partnership, or it is a non-deductible, non-capital expense of the partnership, such as accounts payable for country club dues for an accrual basis partnership. So notice in both cases, it's only for an accrual partnership. And then at the bottom there, we say accrued expenses and accounts payable do not affect basis for a cash basis partnership. So what are we talking about here? What we are saying is, remember, we're talking about a partner's outside basis, and we said that they get basis for their share of partnership liabilities. Well, if it's just a regular loan, that's what number one on the list is, then that's pretty straightforward. Each partner has their proportional share of that loan, and they get basis for that. But what the others are saying is, if you have an accrual basis partnership, then at any given time, they're likely to have accounts payable on their balance sheet. So the rule to remember here is if you have an accrual basis partnership, then the partners get basis for their share of the accounts payable. If you have a cash basis partnership, the partners do not get basis for their share of the accounts payable. That's what you need to remember for the exam. To understand why that is the case, I'll explain it now just for your curiosity, but you don't actually need to know this for the exam. What this is doing is putting partners in accrual basis partnerships on the same footing as partners in a cash basis partnership. Because an accrual basis partnership, when you create an accounts payable, there is going to be a deduction on the partnership's books. And remember, the partner is going to increase or decrease their basis in the partnership depending on the profits or losses of that partnership. So that deduction on the partnership's books decreases their basis in the partnership. So on the end of the year, the profits that are reported out to them are going to be less than they would be if they were a cash basis taxpayer. So they're going to get less of an increase in their basis due to the partnership's profits than they would if they were a cash basis taxpayer. So what this rule is doing is giving them that basis back. It's saying we are going to give you basis because you are still on the hook for that accounts payable. So we're going to increase your basis for your portion of that accounts payable. So on a cash basis taxpayer, of course, they haven't taken a deduction for those expenses. So they haven't reduced their basis because of that's accounts payable. So we're not going to increase their basis here. That wouldn't make any sense. So that is why they are doing this. But again, what you need to remember for the exam is accrual basis partnership, partners get outside basis for their share of accounts payable, cash basis taxpayer, they do not. Disposition of a partnership interest. Just as with any other asset, a partnership interest can be sold or otherwise disposed of. When that happens, the selling partner has a gain or loss on the sale, and the new partner establishes their basis in the partnership interest. For a sale, the gain or loss is generally a capital gain or loss, but there is this exception. The part of the price attributable to accounts receivable or inventory is going to be treated as ordinary gain or loss rather than as capital gain or loss. But remember, the general rule is for a sale, when the partner sells, it is going to be a capital gain or loss. If, on the other hand, instead of a sale, if a partnership interest is abandoned or considered worthless, then that loss is going to be considered ordinary if both of the following are true. First, the transaction is not a sale or exchange. And secondly, the partner has not received an actual or deemed distribution from the partnership. So this would be where the business is just going out of business. It's gone belly up. So the partnership's just not making it. So they sell whatever assets they have. They pay off as much of their debt as they can pay off. But by the time they do that, there's nothing left to distribute out to the partners. So the partnership is just gone. It's worthless. When that is the case, then the loss is going to be an ordinary loss. And that's a good thing from a tax standpoint. It's not a good thing that they went out of business. But from a tax standpoint, that's a good thing because remember, ordinary losses can be used to offset ordinary income. Whereas if it were a capital loss, then it would be limited. So they're saying, okay, you've had a rough time here. Your business is gone. We're going to give you an ordinary loss for that, for your interest in that partnership that has been lost. If a partner retires or dies and receives a liquidating distribution, it will generally be treated as a sale of the interest and result in a capital gain. So here, if the partner retires, then they would personally be receiving the distribution. Of course, if they die, then it would be their estate. But either way, it will be treated as a sale of the interest and result in a capital gain or loss. No loss is recognized if any property other than cash, marketable securities, receivables, and inventory is distributed to the retiring partner. So you can only take a loss if you are receiving those types of property, cash, marketable securities, receivables, and inventory. If you're receiving any other type of property, then you cannot take a loss. That's what that is saying. But again, the general rule is if they retire, they get a distribution, then that will be treated as if it were a sale, and it will result in a capital gain or loss. Cancellation of debt. If a partnership terminates and one partner cannot pay his share of the liabilities, then the other partners may have to pay instead. And as we discussed when we were talking about business deductions, if the other partners have to pay the other partner's debt and that other partner who didn't pay is insolvent, then the partners who do pay can take a bad debt deduction. If the partner is not insolvent, they cannot take a bad debt deduction. However, they can sue the other partner in order to recoup their share of the partnership debt. Now let's talk about Schedule K. So Schedule K and K1, and then Schedule K2 and K3. Schedule K. This is a summary schedule of all the partners' share of the partnership's income, credits, deductions, etc. Rental activity and income is not reported on page 1. So when we were looking at page 1 of the 1065, it had normal operating income and expenses. It did not include rental income and expenses because they're not included there. Instead, they're reported on a separate form, and then the amounts from that form flow up to Schedule K. So these amounts are not combined with trade or business income. They are reported separately on Schedule K. So now let's go ahead and look at the Schedule K so you can see some more specifics about what we are talking about. So it starts out, this is the ordinary business income from page 1. So you do put that on here. So you've got page 1, we figured out the normal income and expense from the business, and the net of that is going to be reported here on Schedule K, and then it's going to be reported on Schedule K1. So the idea here is all of these things are going to be reported out to the partners on their individual K1s, but this is the total amount. And then if you've got two partners, then each, and they're 50-50, then each partner is going to get half the amount that's listed here on Schedule K. If you have a bunch of partners, and let's say you have one partner who's a 2% partner, then they're going to get 2% of the amounts that are listed here on Schedule K. But we have Schedule K to put it all together in one place that can then be distributed out on the Schedule K1s. So you can see line 2 here is that rental real estate income. So you would do the Form 8825, and then the result of that would go here on line 2. And then you can see all of the other things that go on here. The guaranteed payments, total guaranteed payments goes here for services, and then capital, and then we put the total. And then, of course, those are going to be put out. Now, those are not put out proportionally based on percentages. Those guaranteed payments, those will go out specifically to the individuals who received them. So you have one partner got $100,000 in guaranteed payments, that's how much will go on their K1. If another partner got $10,000 in guaranteed payments, that's how much will go on their K1. Then you've got interest, dividends, royalties, etc. Those are all going to be separately stated items. Capital gains and losses, separately stated items, section 179, etc. And then you're going to show cash contributions and deductions by partner. Those will be by partner. And you can see all of the other items that are listed here on Schedule K. Some of these items you're going to rarely see, but they're here just in case. So they have to have them on the form for those rare cases where they might come up. But for most of the time, when you see a Schedule K, there will be a few lines that are filled out, but you're rarely going to have all of the lines filled out. And some of these lines you will very rarely see filled out at all. Then the last part of Schedule K is on top of Schedule L. So we're going to talk about Schedule L, which is the balance sheet. We'll talk about that later. But here we're talking about this part up here. This is the end part of Schedule K. So this is the analysis of net income or loss per the return. And so this is going to show by each partner type the share of the income or loss from Schedule K. So that's what this is. And later we will talk about Schedule M1, which will reconcile book income to this Schedule K analysis of net income. Now the Schedule K1. The K1 shows each partner's separate share. So the line item totals from all the K1s will add up to the amounts that we just saw on Schedule K. And a copy of each K1 is sent to the partners, to each of the partners, their K1 is sent to them for use in filing their income tax return. And each partner is also supposed to get a copy of the instructions for the Schedule K1 or a similar document with the instructions for each line item. So when you send the K1, you also send the instructions for the K1. And what that does is it tells the partner how they're supposed to handle these individual items on their tax return. And a copy of all the K1s are attached to the Form 1065 that is filed by the partnership. So the IRS is going to know what each partner was sent. So therefore, they can do their matching. Their computers can match. They'll know that, okay, this individual got a K1 from the ABC partnership. And so we should see on their tax return the income and loss items from ABC partnership. And so the computers, if they don't see that, then they will generate a notice that will be sent to the partner saying, hey, you didn't report this. You need to explain why, or you need to adjust your tax return accordingly. So let's take a look at AK1 and what it looks like. So it's going to start with the information about the partnership itself, and then the information about the partner. And it's got all of these check boxes, and it's going to have their beginning and ending profit and capital percentages are going to be shown here. Their percentage of liabilities is going to be shown here. Remember, they get basis for things. So the information that is on here can help the partner to compute what their basis in the partnership is. And then over here is all of those items from Schedule K. So remember, the first thing was ordinary business income. That was line 1. And line 2 was net rental income. So this is going to follow down. You've got all of these different items. Now, not every single line item that was on Schedule K is listed here. However, all of those items could be relevant. And so you've got places that they can be put. Other deductions, other information, etc., can be listed. So if you have any of those special kind of rare items, then they can be listed in the other sections. But all of their things will come out to them from the partnership their distributive share of each of these so that they can file their tax return. So that is what the Schedule K1 looks like. Now let's talk about Schedules K2 and K3. So these are relatively new. These just came out within the last couple of years and became mandatory within the last couple of years, but they are something to deal with now. These deal with foreign source income and expenses. So that's what Schedule K2 and K3 deal with, specifically foreign source income and expenses. So Schedule K2 is an extension of Schedule K, meaning it consolidates all of the amounts for the partnership on one form. So all of the foreign source income and expenses for the whole partnership are going to be reported on Schedule K2. Now, all of this income and expenses are also included in Schedule K. They're buried in the numbers. What Schedule K2 and K3 is breaking out the foreign source income and expenses so it can be more easily seen. And this goes back to the IRS being concerned that there is foreign income and expenses that is not being reported, and therefore they are not collecting the tax on. So they're trying to catch people who might be trying to hide assets overseas. That's what all of this is about. So you do a Schedule K2 to break out the foreign source income and expenses for the partnership. And then you issue a Schedule K3 to each of the partners to show them their distributive share of the foreign income and expenses. So that's what the K2 and K3 are about. Now these, I'm not going to show you them. It's similar to the K1, except it's foreign income and foreign expenses. Of course, you want to go, when you're looking at Schedule K and the instructions, you're going to want to look at Schedule K, Schedule K1, Schedule K2, and K3 so that you understand what they are about. But Schedule K2 and K3 do not always have to be filed. So they do not have to be filed if you meet all of these criteria listed on the slide here. If it's a domestic partnership, if there's no foreign activity or it's very little foreign activity, under $300 of foreign taxes paid or accrued, if all the partners are U.S. citizens or U.S.-based entities, if all the partners are notified when they receive their K1 that no K3 is being furnished. So in other words, you have to tell them, hey, we don't need to file a Schedule K2 or K3, so you're not going to get a Schedule K3. And then also, if no partner requests a Schedule K3 within 1 month of when the Form 1065 is filed. So if you don't file the K2, K3, and one of your partners says, hey, you sent me the K1 and you said you weren't going to send me a K3, but I need one. I need a K3. Then you are going to have to go back and file a K2 and K3. And once a partner says one time, 1 year, that they need a K3, then you need to assume that they need that K2 or K3 the next year. So here's what we're saying. If you've got just a domestic partnership, all the partners are domestic people or domestic entities, you don't have any foreign activity or very little foreign activity, then you don't need to bother with the K2 and K3. But if you've got a significant amount of foreign activity, or you've got foreign partners, and remember, you can have all these different entities that can be partners in a partnership. Maybe one of the partners is an LLC, for instance, and a member of the LLC is a foreign person. Well, then you would still have to issue a K2 and K3 with this tax return. So you can't look just at the partners themselves, unless the partners are just individual persons and you know that they're US citizens, then you're fine. But if you have these other entities that are partners in the partnership, then you got to kind of know who owns those entities in order to be able to know whether or not you need a K2 and K3. So sometimes with larger partnerships where you don't really know who the other partners are, you don't know much about those other partners, you just go ahead and attach a K2 and K3 because you're not sure, and that way you make sure your bases are covered. But if you've got just a simple US partnership with US partners without foreign activity, you don't need to worry about the K2 and K3. But if you don't meet all the criteria there on the slide, then you do have to issue the K2 and the K3s. Now let's talk about Schedule L, M1, M2, and M3. So the last page of the 1065 is Schedule L, M1, and M2. Schedule L is the balance sheet. We already saw that. We got a little sneak preview of that. And it is the balance sheet per books. So you are putting whatever basis you use for your books, that is the balance sheet that you're putting on Schedule L. Schedule M1 is a reconciliation of book and tax income. So remember, we talked before about book and tax differences. So this is where you are going to show those. Schedule M1 is only used by quote unquote small partnerships. Large partnerships will use Schedule M3. In any case, Schedule M2 is an analysis of capital accounts. So we'll talk a little bit more about capital accounts in a little while, but that's what Schedule M2 is. It's an analysis of the capital accounts. And then Schedule M3 is the reconciliation of book and tax income for large partnerships. So let's look. This is an overview of the whole form. And so we're going to look at each individual piece. But remember, we had the end of Schedule K up here, that analysis. Then you've got Schedule L, which is the balance sheet. And then you've got Schedule M1, reconciling book and tax income. And then you've got the analysis of the capital accounts. So let's look a little closer at Schedule L. So this is just your basic balance sheet. And you'll see this similar balance sheet on the rest of the entities we will look at as well. This is your balance sheet per books, beginning of the tax year and end of the tax year. So you're going to put them out here. And then it just goes through all of your assets, all of your liabilities and capital. And you can see the capital section here is called partners capital accounts. Of course, that'll look different when we look at the corporations, but that's what the equity section of the balance sheet looks like for the partnership. And then you get your total liabilities and capital at the bottom. Schedule M1 and Schedule M2. So this is a reconciliation of income or loss per books with the analysis of net income. So that's what they're at the top of Schedule L. That's that analysis of net income. So you start with net income per books, and then you make the adjustments here. These things are added, these things are subtracted, and then you come down to the net income or loss per that analysis of net income. So this is going to show when you've got the differences, like meals expense can only be deducted at 50%. You may have income that is tax exempt income. And so that'll go on here as a difference between book and tax. So you'll have all of the different things, the differences between book and tax income. And then Schedule M2 is an analysis of the partner's capital accounts. So you're going to start with what their capital account was at the beginning of the year. You're going to account for any increases, account for any decreases, including contributions and distributions, and then you will come with their capital balance at the end of the year. And again, we'll go into more detail about what increases and decreases capital accounts in a little while. Schedules L, M1, and M2 are not required for all partnerships. So you do not have to file these forms if you satisfy all four of these requirements. You've got less than $250,000 of gross receipts, and gross receipts include sales revenue, interest, dividends, capital gains, and other income. So even though interest, dividends, capital gains, those are separately stated items, they're not on page 1, they are included when we're trying to figure out gross receipts here. So you have to have less than $250,000 of gross receipts, and you have to have less than $1 million of total assets on your books. Your Schedule K1s need to be filed with the return and furnished to the partners on or before the due date. So if you're filing late, then you are going to have to file schedules L, M1, and M2, even if you meet the other exceptions. But as long as you're filing by the due date, including extension, so it's okay to get an extension, and you meet the other criteria, you do not have to file schedules L, M1, and M2. And the partnership is not filing and is not required to file schedule M3, and that's for large partnerships. So if you meet these criteria, in other words, if you're what they're going to consider a very small partnership, then you don't have to file schedule L, M1, and M2. If you are not required to file these, then you have to check the yes box on line 4 of Schedule B. And these schedules can still be completed even if they're not required. So I will just tell you, as a tax preparer, unless I've got a very small partnership, I like to do these. I want to know what Schedule L, M1, and M2 look like. It makes sure that I've accounted for everything. It makes sure that I'm not missing something. So I like to do these. Again, if you got a really small one, maybe you don't do these. And again, you do need to know for the exam these requirements. And we'll look at those here more specifically. This is where you need to check the box. So that this is just saying, does the partnership satisfy all 4 of these? And it's got the 4 things that we just went through. If the answer is yes, then you are not required to file. Even if you want to file, go ahead and check yes that we meet all of these. And then you can go ahead and file it anyway. But it is nice to check yes so that they know that it's not actually required. So now let's talk about Schedule M3. This is for large partnerships. So instead of using that kind of short M1, which is a short reconciliation of book and tax income, the following partnerships are required to use Schedule M3, which we will look at. It's a much longer and more detailed reconciliation of book and tax income. This is for partnerships that have any of the following. Total assets at the end of the year are $10 million or more. Adjusted total assets for the tax year are $10 million or more. For the exam, just know that it's adjusted total assets of $10 million or more. What that is referring to is if you have a cash basis partnership, you have whatever their total assets are, you need to recompute their assets as if they were an accrual basis partnership. So in other words, you're going to put things like accounts receivable on there. And then you have to say, okay, if they were an accrual basis partnership, would they have $10 million or more in assets? That's what that's talking about. Before the exam, just remember, it's either total assets of $10 million or more or adjusted total assets of $10 million or more. Or if it has gross receipts of $35 million or more, and again, gross receipts includes interest, dividends, capital gains, etc. So gross receipts of $35 million or more, or an entity partner which itself is required to file a Schedule M3 owns or is deemed to own an interest of 50% or more in the partnership's capital, profit, or loss on any day during the tax year. So if you have a large partner or partners that in total own 50% or more of the partnership, and those large partners are required to file a Schedule M3, and it could be a large partnership or it could be a large corporation, because large corporations are also required to file a Schedule M3. So if those types of partners own 50% or more of this partnership, then this partnership has to file a Schedule M3, even if they don't meet any of the other criteria. If the partnership is required to file an M3, they must also file Schedule C of Form 1065. Again, that's different than Schedule C of Form 1040, so we will take a look at that as well. Partnerships that are required to file Schedule M3, but have less than $50 million of assets at the end of the year, they can opt to complete only Part 1 of the M3 and to file Schedule M1 instead of filing Parts 2 and 3 of M3. So if you've got a partnership that is required to file, but that partnership has less than 50 million of assets at the end of the year, then they can just do this part one of the M3, and then they would go back and fill out Schedule M1 as well as part one of M3. These partnerships that are less than 50 million of assets, they're not required to do the Schedule C, so they don't have to worry about that. And partnerships who are not required to complete Schedule M3 can choose to do so, but if they choose to do so, then they have to follow the rules. So you don't have to qualify or be required to file an M3 in order to file an M3. But if you choose to file an M3, then you have to follow the rules. So what does the M3 look like? Here it is. Again, you're going to want to get one of these and look at it so that you know. So at the top here is the reason you're filing it. This is the things we just went over. Partnership assets are over 10 million, adjusted total assets over 10 million, etc. So you check the box about why you are filing M3. Or if you're just filing it because you want to, then you would check down here, E, voluntary filer. Then you have part one, which shows the different financial information. You just go through, answer these questions, and check these boxes. So that is all of part one. You're going to show your worldwide income, etc. So this is the basic information. So that is what part one looks like. Then we get over here to part two, and this is the reconciliation. So again, if you're one of those that's required to file M3, but you have less than 50 million of assets, you can skip this part and do M1 and M2 instead. But if you want to, you can fill out this part two. Or if you got more than 50 million of assets, you have to fill out part two. And so what this is a very detailed reconciliation of your book income to your tax income. So this is kind of like the Schedule M1 we looked at on steroids. So it's going to have very much detail as opposed to more general categories that we saw on the M1. And then this is the last page of the M3. It's part three, which is going to show a bunch of other line items that the IRS is looking for information on. So when you have these very large businesses, the IRS wants a lot more information than they have on smaller businesses because they realize that there's a lot more that could be hidden in there that they cannot see. So this is going to give them the information they need to figure out, is this a tax return that we want to look at more closely? So you just fill out these items. Again, for the EA exam, you're not going to be asked to fill out a Schedule M3. If there's going to be any questions about it, there'll be more general questions, just that you understand who has to file an M3. That's really what you need to know for the EA exam. This is that Schedule C of Form 1065, which is additional information. So this is just check boxes that you have to say during the year, did you have any of these other things? Again, the IRS is just looking for other items that they might want to take a closer look at upon an audit. So now we've got just a couple of miscellaneous topics with partnerships. First is capital accounts. So we talked about this before. So in addition to basis, the partnership also keeps track of each partner's equity investment in the partnership. This is their capital account. So remember, on the balance sheet, the equity section was their capital account. So theoretically, what the capital account reflects is the amount the partner would receive upon liquidation of the partnership. So it's just like any other equity. Remember, assets equals liabilities plus ownership equity. So the capital account is the ownership equity section of the balance sheet. Contributions of property, including cash, are credited to the capital account at their fair market value, as opposed to adjusted basis. So remember, when we were talking about the partner's basis, their outside basis in the partnership, they only get credit for their basis in the property that they contributed. So if they contributed something other than cash, like a building, they would only get basis for their adjusted basis in that building or whatever other property it is. For purposes of the capital account, their contributions are treated at their fair market value. Distributions do decrease the capital account. Capital accounts are not affected by partnership liabilities. So remember, basis is get basis for your share of partnership liabilities. That is not a thing for capital accounts. And capital accounts do increase and decrease with partnership profits and losses. So the capital account, again, is simply the equity section of the balance sheet. And so it's going to increase or decrease with profits or losses, just like the equity section of any type of entity would do. So that is the capital account of the partnership. So you do want to know that it is different than the basis. Capital account and basis are two different things, and they are affected differently. And so you will want to understand those differences. Next, the centralized partnership audit regime. So this started in 2018. And what it does is it allows the IRS to assess and collect tax at the partnership level rather than at the individual partner level. This can have a negative impact on the partners since the tax that the IRS will assess is at the highest tax rate. And the partners who enter the partnership after the issue at hand took place could end up paying for something they had nothing to do with. So let's take just a simple example. You could have a partnership that gets audited. So let's say their 2020 tax return gets audited. Well, if you're part of this centralized partnership audit regime, then the IRS, instead of having to audit the partnership, assess tax, and go after each partner individually. So remember, there could be a lot of partners. You could have hundreds of partners. And then the IRS would have to go after each partner for their share of whatever tax they are assessing. So what this allows them to do is just to go to the partnership and say, okay, we found these problems. You owe money. We're going to assess the partnership, and then we're going to assess at the highest individual tax rate, which right now is 37%. And so then the partnership would pay. So remember, we said normally partnerships don't pay tax at the partnership level. Well, this is one case where they do. And so the partnership would pay the tax at that highest tax rate of 37%. Well, let's say you are a partner that was not a member of the partnership in 2020. You didn't come in until 2021 or 2022. Well, you're getting a raw deal here because you, as a partner, you are in effect paying for something that you had nothing to do with. Now, you're not paying out of your own pocket. It's the partnership that is paying. But since you are a partner in the partnership, proportionally, the amount that the partnership is paying to the IRS, you are in effect paying because now that's money that you no longer are entitled to, no longer have access to. So that can be a bummer. Also, you might not be in the 37% tax bracket, but the partnership is going to have to pay tax at that 37% level. So again, you could end up being negatively impacted by this. But it is what it is. And so just know that that's how it works. Eligible partnerships can elect out of this. So if you see those problems that we just talked about as being really big problems, you can elect out of this centralized partnership audit regime if you meet certain criteria. First of all, you have to have 100 or fewer partners. If you got more than 100 partners, the IRS says, no, we're not dealing with it. You have to be part of the centralized partnership audit regime. Also, all the partners must be an individual, a C Corp, a foreign entity that would be treated as a C Corp if it were not a foreign entity, an S Corp, or an estate of a deceased partner. So if you have any other types of entities as partners other than those, then you cannot elect out of the centralized partnership audit regime. And there must be fewer than 100 K1 issued. For this purpose, the K1s issued by any S Corp that is a partner are added to the K1s issued by the partnership itself. So maybe you've got fewer than 100 partners, so that's not a problem. So that means that the partnership itself is sending out fewer than 100 K1s, obviously. But if one of your partners or one or more of your partners is an S Corp, and maybe that S Corp has got 50 shareholders that they're sending K1s to, well, you have to count those 50 K1s to decide whether or not you are meeting this test. So let's say the partnership itself is sending out 80 K1s because there's 80 partners, but then they've got this S Corp that's sending out 50 K1s. Well, that's 130. So you cannot elect out of the centralized partnership audit regime. Or let's say it's not one S Corp that's sending out 50 K1s, but let's say there's 20 S Corps that are all partners. And in total, those 20 S Corps send out 50 K1s. Same thing. You still got more than 100 total K1s being issued. So you cannot elect out. The election to elect out is made annually, so it's not a one and done thing. You have to elect it each year on the Form 1065 to elect out. Otherwise, you will be automatically included in it. In other words, the default is you are part of the centralized partnership audit regime. In order to not be, you have to meet the criteria and you have to elect out each year. Partnerships who are subject to the centralized audit regime, which is most partnerships. So because it's the default, most partnerships are going to be subject to the centralized partnership audit regime. And so if they are and they need to make a change, they do not file an amended Form 1065. Instead, they file an administrative adjustment request, an AAR form, to report whatever the change in treatment is. So just remember that for the exam. Partnership that is subject to the centralized partnership audit regime does not file an amended 1065. They file an administrative adjustment request instead. A partnership representative under this regime, partnerships are required to designate a partnership representative. So before we had this regime, there was something called a tax matters partner. So this took the place of a tax matters partner. So you have to have a designated partnership representative. That representative has sole authority to act on behalf of the partnership before the IRS. So the other partners cannot represent the partnership before the IRS. Only this partnership representative, the designated partnership representative, and that representative must have a substantial presence in the United States and must be designated on the Form 1065. So each year you have to designate who is the partnership representative, and that representative has to have a substantial presence in the United States. So that is the end of video 5. A lot of information in there. This may be one that you want to go back and watch again. You certainly would want to get a copy of the slides and then study those slides. Look at the 1065 and all of the forms, the K, the K1, etc., the instructions for the 1065, the publication on partnerships. Read through that, go over it again and again until you get the concepts that are here. And again, focus on the basic concepts, focus on the simple scenarios, individual partners, just 2 or 3 of them. They're not going to test you on the exam if you've got 54 partners. It's going to be simpler type of partnership structures. And just make sure you can understand a little bit about basis, inside basis, outside basis, the difference with capital accounts, how the liabilities are handled, et cetera, and so forth. Go through, get the basic ideas down, the basic concepts down, and you will be good to go for the EA exam. In the meantime, I will see you on video 6.